Because if it happens, then just turn off the TV really quickly. You know.
Hey guys, welcome to the live stream. This is Andrew, and you're listening to Burr Cashflow Investors. So today we have a bunch of questions since it is Monday, and the first one we will start with is about incorporated versus unincorporated areas. How do I identify if a property is in a incorporated area or is it in a unincorporated area? So how do I do that? And before we get started, I want to remind everybody there is a meeting that is coming up, which is going to be tomorrow, and that one is going to be specifically about long-term wealth with Airbnb. So make sure if you haven't put the time aside tomorrow at 6:30, you can be at the office or join us online for long-term wealth with Airbnbs. So make sure that you attend. I think you'll get a ton of great content from that, because now I'm up at about 25 Airbnbs this year. I mean, I should say last year, my goal was up to 50 in 1 year, right? I didn't get to 50, but that's the next goal, is to get to 50. But what I'm trying to ultimately get to is 100 Airbnbs just in the Chicago market. And the goal is 1,500 per month from every single Airbnb. That doesn't count any of the rental properties I have, but can you legitimately make $150,000 a month just from Airbnbs? And the race is on, right? We're already at a certain level. Like with 25 Airbnbs, I'm doing about 19,000 with on the thing, because some of them are still settling in. They came on the market in the winter season, so some of them are performing phenomenally well. Some of them are not. So some of them, as they came online, now they're making more money. But the ones that are performing $1,500 to $2,000 a month after all expenses. The ones that are not, they're still lagging behind, and we're course correcting that, because not every place Airbnbs are working phenomenally. The ones that do work very well, but we'll talk about that during the meeting. Having said that, one of the questions that came up was that how do you identify an unincorporated area versus an incorporated area? Is there a website that lists the area that are incorporated or unincorporated? Yes. So if you go to the local county website, DuPage County, Cook County, Kane County, whatever, you can basically pull a map of all the areas that are incorporated and not incorporated. That's not a problem. But more than that, what you can also do is identify it, at least in the Chicagoland area. Other areas, this is not the case, but in Chicagoland area, around the suburbs, like in Florida, you cannot tell the difference. The address is kind of the same. So it's 1628 Tilley Street, that's unincorporated. And then I have a property on 12534 Buffing Road, right? That's incorporated. So the addresses don't tell the difference. In the Chicagoland and surrounding areas, the way it works is you have, let's say, 1646 Sherman, right? That's going to be incorporated. If it says 16W228 Sherman, that's going to be unincorporated. So unincorporated areas around Cook County, Lake County, DuPage County, Kane County, in these areas, they will have a W, meaning west, north, N, east, or east, west, north, south. So south, right? So basically they have the directions of the street, I believe, but they have it incorporated in the address, and those are generally in the unincorporated areas. The best way of verifying that is just go online to search of Cook County, blah, blah, search for the tax bill, and then there it'll say whether it's an unincorporated area or an not an incorporated area, and it will basically tell you that. Then you know black and white whether it is incorporated or unincorporated. But a general rule of thumb, if it has a east, west, north, south in the address, which is 12W664, that is unincorporated. If it does not have that, then it is going to be unincorporated. So that's just incorporated will not have the direction in the middle of the address, and unincorporated will. So hopefully what I said was clear. Second, what are you doing to find business in this tough market? So I'm not sure what business are you talking about, as far as, are you talking about as a real estate agent in terms of finding business, or if you're talking about as far as deals, right? So I'll cover both of them because I used to be a real estate agent. And this is something, guys, just please understand, right? good market or bad market, there are deals that are happening. Obviously, as the market shrinks, meaning there are not as many sales, then guess what you're going to have to do? You're going to have to put your head down and go to work. Right? And most companies, most businesses actually grow. I know this is, sometimes people don't believe this, but think about what happens. What happens is that in a bad market, a lot of people quit the business. That's going on right now. A lot of real estate agents, they're not making as much as they were making because there's not as many sales. So they'll quit the business. Now, what it does is for you, if you're willing to put the head down, you're going to realize, hey, the market is a tough market because there's not as many sales happening as there were. So 2 years ago, there were 6 million sales. Last year, there were barely 4.5 million. That's 1.5 million sales gone, right? And there were 2.5, 3 million realtors that were in the business, a bunch of them. And this happens every time the economy turns. So what you have to make it your business is, number one, are you asking, if you're in the real estate business, are you asking for referrals? Right? Are you asking for referrals with the existing customer base? Are you asking for referrals with your existing people? Number two, if you're doing the investment side of it, who are you targeting? What is your specific game plan to ask for referrals? Right? Meaning, hey, I buy a lot of distressed properties, and are you a talking and walking billboard for yourself? Right? This is a hard one for me. I know a lot of people have this perception that, oh my God, Andrew, you're very outgoing. I'm actually not. I'm an introvert by nature, and generally, unless I know the people, I don't like talking to people. Talking on camera is different. Talking in front of people is different. But one-on-one, generally, I don't like doing that because I'm asking somebody for something. And a lot of times what you're doing is you're advertising, right? And that is something that is important to understand. Number two is, who are you going after? So if you're an investor or if you are an agent, right? Both things in this market, are you going after the cancels? Are you going after properties that are expired listings? You should be, because guess what? If you don't, your competition's going to, or some agents that are aggressive, they're going to. So you have to think about it as a real estate investor, right? We have a bunch of people in Mastery that go after expired listings, canceled listings, which are overpriced. Like Shantanu bought that huge 6-unit building. He found it because it was an expired listing, right? Canceled listing. That's how he found it. I used to get all my business from 3 lead sources: expireds, cancels, for sale by owners. Now, did I have to call them? Did I have to do a lot of follow-up? Yes. But I didn't know any other way of making $350,000, $400,000 selling real estate. So that's what I did. And I didn't want to work with buyers because that's a lot of work. So the way I found my business was that I basically went after all the business that other agents did not want to go after. So the other issue is that if you're looking for business in a tough economy like today, are you an expert? Let's say you live in Naperville, right? You as an agent should have bunch of videos about Naperville, right? If that's where you want to dominate the market, or if you want to be in Oak Brook, at the end of the day, he who is heard is going to end up getting and cleaning up all the business, right? That is just how it is. That social media today is such a powerful tool that the person who is at the top of their mind, guess what? That's the person that is going to get all the business. This is how it is today, and either you're going to get with it. We're trying to get better. Right? We are not as good at social media. And this is something that huge commitment I've made. We got 3 new people in that media department this year that we're going to grow that side of the business, period. There's just no ifs, ands, or buts about it because it's that important. And it's that important for you as an investor, and it's that important for you as an agent. If you're asking that question from the agent side of it, is, are you out there? Are you ever present in people's minds? Right? And see, here's the thing, that if you're working during tough markets, people got very lazy. Last 2-3 years, people got very lazy because there was just so much business we had. Everybody was buying houses. You could literally get into real estate and just make a boatload of money. Why? Because everybody was buying houses. Now you actually have to go out there proactively, find deals. No different on the investment side is, so on the investment side of things, not only are we looking more at the MLS stuff, but besides that, we're looking at auctions online and basically all the ones that are live sheriff auctions. And I'm doing some mailings this year, and we're doing some cold calls. So we're doing both of those strategies this year on the investment side of things. The other question was, next question was, do you issue a 1099 to a handyman if that was mostly a service call during the year? So the way you have to look at it is this, that I roughly paid $2,900 to him in 2023, mostly small transactions of like 100 or 300 range, and that's what it is. So if somebody basically has a LLC and they basically bill you, what you have to look at is, and this is my opinion, mind you, because I'm not a CPA, I don't feel I'm the most qualified, so check with the CPA, but this is my opinion. If majority of their income does not come from you, then you are going to have to give them, then you don't have to give them a 1099 or anything. You basically just, you paid their LLC and that's it. Right? Everybody's LLC that you buy anything from, whether it's $1,000, $2,000, $10,000, do you give everybody an 1099? I'd be issuing, 100 1099s. That would just not practical. That's not what the IRS expects, right? It's supposed to be on their side of the income. That has nothing to do with you. You have an expense structure going out. Now, if somebody is getting a 1099 from you, they're getting 40, 50, 60, 80, $90,000 of income from you. Like I have contractors where, like last year, there are guys who have paid, $250,000, $300,000. Like we have a plumber, right? We have an in-house plumber, not in-house as in he doesn't exclusively work for me. He does a lot of other plumbing jobs, but I'm one of his big accounts, right? So I paid him last year close to $300,000 just in plumbing bills, right, in a year. And this is changing sewer pipes. This is changing all new plumbing, all this kind of stuff, right? Even him, I'm not issuing him a 1099. Why? Because majority of his income is coming from other places also. So majority of his income is not coming from me. Now, in the contrast of that, I have another guy. His name is Juan, right? So he has a construction company where he gets a 1099 from me because 80%, maybe not 80%, 75% to 80% of his income for the year is coming because he's working on my projects. Doesn't mean he exclusively works for me, doesn't mean I control his hours, but I certainly give him a ton of projects back to back to back to back to back. So for him, I issue a 1099 to his LLC. There's another guy, same exact sort of situation where for BPC Construction, we issue him a 1099. Now, the concrete guy, the people who do the roofing, the people who do the electrical, the people who do those guys, we do not issue 1099s to because majority of their income is not necessarily coming from me. Maybe 20, 30%, 40%, but not majority of their income. But if majority of somebody's income comes from us, to my understanding, we issue them a 1099 because even though we're paying their LLCs, it is coming from my end, then I'm supposed to report it. Hence, we report that. But for $2,000, $3,000 only, right? If 99% of work in this, clearly for this person's case, you're not his main source of employment, so then I would not worry about it. What's your go-to on finding owners of properties when the property is an LLC or a corporation? So it's very simple. If you're looking for a homeowner, for an owner that is a LLC or a corporation, number one, if it's a LLC here in Illinois, it's simple. Just go to Illinois Business Services, type in their LLC name, right, and do a search. Don't put LLC or C Corp, just do a search for all, and it'll give you the LLC and the names of the people that are associated with that LLC. It'll also give you a mailing address for the agent and or the mailing address for the members of the LLC, and then you can directly contact them. You can skip trace that also with IDI. You can skip trace that and go about it that way. So if it's in another state, it works the same. Right? Most of the states you can find out who the owners of the LLC are. So 95% times it's not a problem. Even if they have an agent, you can always reach the agent for the LLC. It may be an attorney, it may be somebody else who is acting as an agent for the LLC. The next question was, this is based on a question where this is a financing question, which is that what should I be doing? And let me get a pen to make sure that I have. So this is a person that bought this particular property, and we had talked about this property about 3 weeks ago. The property was bought for, not 3 weeks, excuse me, about 8-9 weeks ago. The property was bought for about $180,000. They ended up doing about $90,000 in work. So I'm just going to round it up to, they're in this deal for about $300K. Appraisal just came back at $520K. So their question to me was, well, how much should I refinance on this property? Now they're doing a commercial loan, so they can refinance a good bit on this property. So let's just look at the numbers, and I'm going to do the numbers based on how I would do it, right? So on 520,000, how much is the maximum that they can refinance? The maximum they could refinance is going to be 390, right? 390,000 is what they can refinance on this particular property. Now we know this property, we already know what this is. This is a 3-unit building, is what this property is. So because this property is a 3-unit building, the way I would look at it is this. Just because I can refinance 390 doesn't mean I'm going to go up to 390. The way I would look at it is this. 3-unit building, I know this building, and I know the numbers, that's what I'm telling you. I know this building on a gross, right? They're making about $4,900 in total gross rent is what their rent is, right? So I'm going to take the total gross rent and I'm going to look at, okay, in a 3-unit building, what is the ideal kind of cash flow that I would want? So the ideal cash flow I would want is on this is $1,500, $500 per door. That's phenomenal, right? Now, what I'm going to do is I'm going to take their total income, $4,900 minus $1,500, and that gives me $3,400. Now, why is that $3,400 important? So that $3,400 is important because that's the money that is you can put towards principal, interest, taxes, insurance. But wait a minute, there's another couple expenses that they're going to have to think about. In this particular building, they are responsible for the utilities. Now, given this particular building, the only utility they're responsible for in this particular case is they've separated all the HVAC units. So heating, they're not responsible for. They are responsible, though, for water, number one, in terms of utility. Number two, they're responsible for garbage pickup. That's going to be garbage. And then number three, they're responsible for grass cutting a little bit and snow. Right? So you're going to have a little bit of expense a month in terms of if you take those account. Now, water bills don't come in every month. They come in every, I believe it's every 3 months, if I'm not mistaken, something like that, every 3 months. So in a property like this, generally the water bill is going to be about, I think our background screen is kind of messing up. But anyways, the water bill in general is going to be somewhere around, say, $150 or so. Right? And now, in this particular unit, they have a 3-unit laundry, right? Excuse me, they have, in this 3-unit building, they have 2 laundry units, meaning they have 2 washers and 2 dryers. So they're going to generate some money from it. How much money? In a building like this, generally, they're going to generate about $1,500 a year. Right? That's what they're going to generate to 2,000, depending on who it is. Right? I always kid about this. If it's Hispanic people love to do more laundry. So if you have a bunch of Hispanic tenants in a building like this, right, for some reason you get more revenue than everybody else. I have no idea why, but it's always an old running joke we have. So you'll have a little bit of an offset, obviously, from the laundry. But the way I would do it is you have total rent $4,900. Your PITI is your cash flow you want is $1,500. So now I have $3,400 left towards expenses. Now, out of $3,400, I'm going to subtract another about $300 a month. That's going to be my water. That's going to be my other utilities, like the common hall area light, and it's going to cover some, water expense and electricity for the laundry area. Now, the laundry area, they're going to make some money from that, obviously, but we'll just consider that as an offset. So if I take $3,400, take another $300 out of it, I have $3,100. Now, I'm going to go back and I'm going to put it, if this is a calculator, now if you're from Mastery, use the Mastery calculator. If you're not, I would highly suggest download a calculator. It's called Carls, K-A-R-L-S, Carls Mortgage Calculator, right? If you download that. So now what you do is what this calculator, why I love this calculator is it'll help you do a calculation for the payment. In this, we're not going to do a calculation for how much, right? So it'll back calculate, hey, how much should I be pulling out of this property? So the way you do that is this. I'm going to put in, okay, what are the taxes in this property? I know the taxes are going to be about $8,000. I know insurance on the property is $2,000. Okay. And then now I'm going to go figure out backwards that what is the principal that I should be picking up on it. Okay. And then payments, I can do 3,100 towards my payments. 3100 and 7.45 is the rate that they're getting in this particular case. Voila. What this does, it gives me, I can put a loan. Well, actually, hold on. 3,100 payments. Actually, I got to take that down a little bit because it's adding the things in it. So I'm going to put 3,100. So enter. So it's going to be 2,100. Okay. So here's what it gives me. What it gives me is this, that if I want to have $1,500 cash flow from this property, even though I can get a loan on this property for $390,000 based on the appraised value, if I put too big a loan on it, what's going to happen? My cash flow is basically going to zero, right? So just because I can get a big loan on it, I'm not going to put a big loan on it. What this says is I could do a loan on this particular property up to $305,000, right, in terms of loan. So that means I would be fully cashed out. I would have zero money out of pocket. I would have $1,500 that would cash flow from the particular property, and I would have no money in the deal. So I would have equity in the property of close to almost $200,000, right? Actually, $220,000 in equity. I would have $1,500 in the cash flow in every single month, and I would have a phenomenally good DCR. Those are the three things that we invest for. Now, some people will be like, but Andrew, that makes no sense. I'm going to put a loan on it for $350 or $380 or $390. I'm going to get the max amount of money out because I'm going to go buy more properties. If you choose to do that, that's fine. That's up to you. I will not do that. That's not how I buy properties, right? That's just me. That I want to have a good cash flow that comes in from the property, right? And this is really, really important for you to consider. Now, if your goal is something different, that's okay. There's nothing wrong with it, but just please understand that that's not how I buy the properties. Hence, I'm not going to do that. So in this particular property, even though the property was bought for 180, fixed up for 90 approximately, and that fix up 90 expense has their loan cost built into it also. That's why it's actually the fix up was only 65,000. So some of those costs are built in. So I said they're in this deal for about 300. Appraisal came back at 520. They're going to get 75% of that appraisal number. And the question was, how much of a loan should I be putting on the deal? To me, you should not be putting any more than 305 or so on the deal because you want to have good, healthy cash flow. That's why you bought the property. You have a phenomenally good building. So for this person, for this couple, I should say, this is their building number 2. They live in one. This is the second building that they bought. Guys, stick with the strategy. This is working for you. I know these buildings are harder to find. Last year, they had bought one. This is the second one that they had bought. And they were like, Andrew, we really want to do this. We really want to scale. I'm like, listen, what is more important is not just scale. What is more important is good quality cash flow and good quality properties. So my request to you would be is don't step out of the area. You're good at this, right? Keep looking in the same area. You already understand the numbers now, and now it's just a matter of rinse and repeat. Even if you do 2 or 3 good quality buildings like this one, a year, believe me, in a 1.5 to 2 year period, you will be at an amazing, amazing, amazing place in life. So don't make it too complicated. Keep it very, very simple, and let's keep growing. So thank you that you did the follow-up, because I know a few months back, we had analyzed this building. I had said that buy the building, do not pass it, do not flip it. So I'm very happy to see that you did not flip it. But guess what? You have $1,500 a month, 1,500 times 12, that's 18,000. You add that with your first building, I know you're living in it, but that makes them about $450 a month. So it's not a lot of cash flow. But guys, listen, it's $2,000 in cash flow they did not have. That's $24,000. Now they just have to repeat it with another 2-3 buildings, and they will be in great financial shape compared to where they were when they did not have any property. So it's kind of exciting that not only this happens obviously a lot in Mastery, but this is happening here. So this is exciting. Now, next question was a little bit different question, really the same thing. So what is the type of loan I should be getting right now? Should I be getting a 30-year residential loan for rental property because the rate is going to be a little less? Number two is, should I be doing a loan with somebody like Joe, which is a portfolio loan, or should I be doing a 30-year fixed loan? So my question to you is going to be, is that based on what your business plan is. So meaning that if you don't have to do a residential loan, I would not do a residential loan 30-year fixed, right? I know you're going to get an interest rate that's going to be a little bit cheaper, but like the property this person is buying, this particular property is an inexpensive property, meaning the property they're all in cost, purchase plus rehab cost, all of that put together, they're in it for 115. So I would not take up one of my slots, because as a residential rental on one person's name, you only get 9 slots, right? As a residential. Commercial, you can do as many as possible. So I would only reserve your commercial residential loans on properties that have higher balances, because your interest rate is going to be a little bit lower. So that's why I would reserve that on those. I would not use that slot up. So in this particular case, either you go to Joe. Joe will be happy to give you a loan at somewhere around, I think, 6.8, I believe his rates are running right now. I believe commercial rates are 7.5 or so, 7.7, depending on who you are and what you're getting. But his rates are going to be a little bit lower, about a 3/4 of a point to a point lower. So I would go to Joe. I would do a 5-year balloon. When the rates are down, then you can basically do a different rate and go from there, or just do a 30-year commercial loan. And when the rates go down, understand you're going to have to do a refinance. But this is a good property. I like this property. Property was bought for $72,000. Fix up was a little bit high, and the tenants had to be moved out. So that took a little time. They did cash or keys. This is a property that they bought. This is in an area called Crete, C-R-E-T-E. Small little town down south. So this is a home run deal, because the back end value on this property came back at $246. Guys, you're in the property for $115,000, right? Now, this is artificially low because this person did the work themselves, but you should be proud of yourself, because the property is $246 property. You're in it for $115. Do not sell this property. I know what your real estate agent is telling you. Imagine you can make XYZ. Just tell the real estate agent, please. Be an agent, do a good job finding me more properties. Don't tell me how to build wealth, right? So guys, do not sell this property. It's too good a property for you to keep. You're going to cash flow hand over fist on this property, right? Literally, you're going to cash flow hand over fist. Your rental over here, they have a rental that somebody's interested at $2,300. $2,300 in rent, and their payments are maybe $1,300, $1,200-$1,300, right? It's just too good a property. You're going to be 100% out of the deal in terms of your cash flow, in terms of your the money out of the deal. So please do not sell this particular property. I'm proud of what you guys have done. So congratulations again from my end. This is exciting property. So super thrilled, but just put a commercial loan on it for now. Don't take a prepay on it. Right? Do not do a 5-4-3-2-1 right now, because we're expecting the rates to go down. You can also do an interest-only loan right now. You don't have to do I don't like interest-only loans at all, personally. I do not like them. But sometimes if your numbers are off a little bit, you may have to do that. In this case, you're not going to have that issue. You have a lot of equity in the property. So congratulations. Again, having said that, guys, tomorrow the meeting that's coming up is on long-term Airbnbs. So make sure you engage with that. Make sure you show up. Make sure you participate. Ask lots of questions. And super thrilled, because we're literally less than 3 weeks out to the 3-day event. This is going to be humongous. The question is, are you going to be there, and are you going to get started? See, remember, it's not about just showing up. It's about participating. Are you willing to play the game? Excuse me. And I will talk to you guys soon.